All righty. I know you want to know what's coming down the pipe with stock markets. You want to know. I want to know. There is this thing called the Santa Claus rally, the January effect. Well, it is in the books and it is time to see the future. All right, Dan, tell us what's coming down the pipeline.
That's an interesting way to phrase it. Time to see the future.
There you go.
It kind of is like that. I mean, that's what I'm going to show you. I'm going to show you the proof over, back to 1950 of how the January effect has predicted the outcome of the year, the balance of the year, the last 11 months after January.
Yep.
And now that January is over, we have the data. So we can take a look at it, right?
Yeah. At the end of the day, folks, this is not financial advice. This is two guys talking on the internet using historical data since 1950. But hey, let's see what it has to say.
Yeah, that's a good point. And by the way, anyone is free to disagree with any of this.
Of course.
That's fine. I just present the data. I'm just presenting, what the historical data looks like. And anyone can make their own decisions on whether this year is going to be an outlier and not follow the average, or if it will follow the average.
Yep.
But at least I think it's important to know what that historical data is. So anyway, if you want my newsletter, go to breakpointtrading.net and click on this link right here, and it's free. You can download the newsletter. If you want to be reminded that it's available, just sign up with your email. We don't ask for a credit card, and we don't share emails. We don't sell emails. You won't get any spam by coming to my site because I don't share anybody's email. So let's take a look. Here's the Santa rally. I call the Santa rally. This is part of my website, by the way. So 2023 Santa rally was positive for all three of these components. So the components of the January effect is number one, Santa rally, which is the last 5 days of the year plus the first 2 days of the new year. That was up 0.8%. The second piece is the first 5 days of January, and that was up 1.4%. And then the third piece is the full month of January, which was up 6% in last year. So all three were positive. And as we know, when 2023 started, the market was at 38.24.
Mm-hmm.
And when it ended, we're at about 4,800. So 1,000-point gain in that period. So that was last year's Santa rally. That was 3 for 3.
Yep.
This year's Santa rally, or I'm sorry, the January barometer, the Santa rally part of it, number one, was minus 1%. So that was a negative. First 5 days was basically flat, but it was minus 0.13. So the first two were negative. The third piece, which is the full month, was up slightly, up 1.59%. So the third piece was actually positive. So that's good news. So if we look at what that means over here, so there's this year.
Yep.
And this is from Stock Traders Almanac. The upper right box up here is when the first two are down and the third one is up.
Okay. So that's what we experienced.
This is what we just went through right here. So you can see the years when that happened. 2024 is the one we just finished. 85, 91, and 93 were the other years when two of them were down and one was up.
I remember 91 because I graduated in 90. 91.
Right.
I had my first. Yeah. I remember 91. Okay.
Yeah.
Oh, 93 also.
Oh. 93. Yeah. Okay. So all 4 of these years, the first two were down. The last one was up. The last 11 months in 85 was up 17%. 91 was up 21. 93 was up 6. The full year, 26, 26, and 7.1. Huh. So the January effect, you want to see them all positive, but then you want to see what effect that has on the balance of the year. So the last 11 months, right? And then you add whatever those last 11 months did to that first month of January.
Right. Okay.
You get 26.3. On average, 19.9%. Median, 26% for the full year. All right. 3 up, 0 down. Pretty good record.
Pretty good record. Not a huge sample size, but it's okay. All right.
Now, well, the sample size goes back to 1950.
True.
So it is a pretty big sample size. But these are the only years that was 2 out of 3 negative.
Right.
Right.
Okay. Yeah, yeah. I understand.
So 20%. Then that does not, since this is what we did this year, that does not mean we're going to go up 20% this year.
No, it does not mean
it just means, as you said, for this small sample size of 4 years, actually just 3 years, the average was up 20%. But the average overall is all of them up. So we most likely are going to be up this year.
Okay.
And I'm going to show you some information in a second that will kind of give you some more data about this. So this is when all 3 are down. On average, it's down minus 3.6%. And these are the years when all 3 were down. You know, they put 2024 because we hadn't finished January yet when this slide was created. So they didn't know if we'd end up here or down here. But these are the years where all 3 were down. 2016, 2008, of course, 2000, of course, right? 82 was the end of the secular bear market. 78, 69 was the beginning of I think that was actually the beginning of a secular bear market right there. So that's what the data shows us so far. So let's take a look at these slides here were done by Tom Bowley. He did a presentation, which was a really good presentation. And I'm going to kind of paraphrase what he provided because I think it's pretty powerful the way he analyzed the same thing. So he took the same data back to 1950 for the S&P. The NASDAQ's only been in existence since 71, so full year 72. And the Russell's only been in existence since 87, so full year of 88.
Okay.
So we'll focus on the S&P, and I'll show you the NASDAQ, but I'm not going to spend a lot of time on it. So again, as I said, 2024, we were up 1.59% for January. That puts us, and what this is all the way back to 1950, just divided all of those years into quartiles. Got it. Of the best Januaries. All right. So this first quartile are the quarter that had the best Januaries. On average, they were up 7%. Got it. The second quartile are the second group that had the best Januaries, and they were up 3%. Right. The third quartile is the next best Januaries, which were down 1%. And the last quartile are the worst quarter of that grouping from 1950 to, so what's that, 75 years, down minus 5%. So up 1.59% puts us in the second quartile. Got it. Of all Januaries. And the green one is the balance of the year performance on average. So if you're in the first quartile, on average, the rest of the year, so 11 months, was up 15%. So if you add 15 to 7, that's up 22% on average for the year if you're in quartile 1. In quartile 2, the balance of the year is up 10% plus the 3, so that's 13%. Okay, follow?
Yep, absolutely.
All right, so let's take a look at this in a little more detail. So this is where we are, 2024, we're in quartile 2. What does that mean if you're in quartile 2 right here? And he did this analysis on every single year and compared them all. And the balance of the year, the years that were over 20%, 10% of all of those years was over 20% gain. All right. But the ones to focus on is this one that I highlighted here in blue. The ones that were over 10%, 58% of the years were over 10%. Right. That's a pretty good record. Yeah. And 84% were positive for the year. Somewhere between 0 and 10%. Or actually 0 and above, because this includes the 10 and the 20s as well. Right. Right. So 84% of years when you're in the second quartile are positive years, and 58% are better than 10% for the year. Okay. Now, if you just look at this and you start listening to the people that say we're going back to the lows of 2022,
No.
3,500, or we're going back to the COVID lows, or we're going to crash here this year. The data does not bear that out. The data says, I mean, yes, we could be in the 16% and actually even less than that. So if you look at the years here in second quartile that were less than 10%, it's
Right.
only 1 year.
Got
Only
it.
1 year. If you look at the years that were less than 20% in the second quartile, it was 0.
Right.
It's never been less than 20%.
Okay.
So we are not going down, we are going up. And last week I
according
talked
to
about
this data. According to
the data.
Yep.
It's not just this data, it's the data. This is the data.
Yep.
So last year I talked about the presidential cycle and that the presidential year usually ends higher.
Mm-hmm.
So take this in context with that. So you got two things to think about. Now,
Okay.
if we look at the individual years for each one of these quartiles, you can see the ones, and this is how this is all put together. So 1987 was in quartile 1. It was the best performing year in quartile 1. January was up 13%, but look what happened for the whole balance of the year, down 9%.
Yep.
But you know what
Black
happened?
Monday. Black Monday.
Black Monday, 1987. If we go all the way to quartile 4, to the last one, the worst performing in January of all of these years back to 1950, the worst performing year was 2009, but yet it was up 35% balance of the year.
Okay.
All right. So those are the outliers. Anytime you look at data, you will have outliers. So there are your outliers right there. 2009. Oops. Let me go back again. I don't want to show you that one yet. 2009 right there are the outliers. Now, where are we? Where this green line is right down here. So 2024 is 1.59%. That puts us right in here for quartile 2. Okay. So on average, if you look at all of these years, on average, the January up was 2.83%. So we're a little below that. The average for the balance of the year is up 10%.
Got it.
Okay. Now I thought, what if we looked at this from the perspective of secular bull and bear markets? How would these years fit in?
Okay.
My secular bull and bear theory that I've talked about so many times.
Oh yeah. Yep.
So what I did was I highlighted the years that were the secular bulls, and the years that were secular bears.
Okay.
And this is what it looks like.
Huh.
Now you can see in quartile 1, only 4 of these positive years were in secular bear markets: 1980, 75, 76, and 2012. All of the rest of these occurred in secular bull markets.
Right.
In quartile 2, there are a few more bears, but there's still quite a few bulls in that one as well. And then when you get over here to quartile 4, there's still a lot from the secular bull markets. So what this means is, and I've said this before, in a secular bull, you can always have cyclical bear markets. So you can have cyclical bears. So the bull market was from 1981 to 2001, right?
Yep.
So, and the bear market was from basically 2001 until 2013. So 2012 was a secular bear market technically, but it still ended up in quartile 1. Because remember, the bottom was in 2009 right here.
Right.
So the market was already starting to come out. I just thought that was interesting. But
yeah,
right now we are in that quartile 2.
Okay.
We look at the NASDAQ, kind of the same thing, but now NASDAQ is in quartile 3. And you can see with the NASDAQ, it's not as big a sample size because it only goes back to 72. But rather than dropping like the S&P did, it sort of is stable in the first 3 quartiles, and the 4th quartile drops off quite a bit.
Okay.
So it's a 69% chance of being positive for the NASDAQ and 53% chance of being above 10%.
Got it.
For the NASDAQ. And that's where the NASDAQ fits into all of the years right there. And the Russell is all over the place. So the Russell has even less to look at.
Right.
Even fewer years to in its sample size. And the interesting thing about the Russell 2000, though, is that it doesn't really decline or go up like the other ones do. It just sort of goes sideways. It doesn't matter that much which quartile it's in. So even so, 55% chance of it being higher.
Okay.
In this year. And then there's the quartile. There's all the years. You can see there are fewer and fewer years.
Yeah.
In the Russell. So this year fits right in here for the Russell.
Okay.
So the Russell actually has a lot of catch up to do. It might be the one that is poised to start to move higher this year. So we'll see. But I just thought all that was interesting. Interesting way to look at the January effect and what it means. I think in general, what it means, the conclusion that I come to is that we most likely will have a positive year when you combine this with the presidential cycle as well.
Okay.
And March, the March timeframe, February, March, somewhere in that timeframe might be the low of the year. So anyone thinking of positioning themselves for the rest of the year, that would be the time to take a look at, especially if we have a pullback, and based on the negative divergences that I talked about in the last video, I think it's lining up to have that pullback in the March timeframe.
Sure.
And then I think we're going to be higher by the end of the year.
Very, very cool. Well, we appreciate you doing all of this work for us, putting that together in some pretty crystal clear pictures. Shout out Tom Bowley for all that he does. Show your website one more time so we can get your free newsletter.
Sure. Okay, hang on a second here. Right here, breakpointtrading.net. Free newsletter is right here. I put some of this information in the newsletter as well this week. I also, by the way, if I click on that and go to the newsletter, I also put in here some interesting stuff about retirement that I got from another site. You know,
cool.
What people think about retirement, you know, stocks or real estate. You know, is that where their money should be? This is the average of the S&P, and the average is around 8.45% over time. We've been above that recently. But the real interesting one is this one right here that basically says not enough people are saving for retirement.
Yeah.
Right? How much do you currently have saved for retirement? 22% is $0.
That's not good.
No, that's not good.
That's not good.
So, you know, we'll see how it all plays out. But this was an interesting article that's in the newsletter, this week's newsletter.
Very cool.
It's an interesting article with some interesting data to look over. So just wanted to point that out.
Dan, we appreciate you, man. I look at your newsletter every week, and we'll see you in Vegas in a couple of weeks.
Sounds good. 2 weeks, man.
There you go. Thanks, bud.
See you there. And go 49ers.
Yeah, go Niners.